Imagine, cutting out the middleman, just lending money directly to the U.S. government from your couch.
Right.
That's not just like an idea. It's what we're diving into today. Buying US Treasury securities straight from the source using TreasuryDirect.gov.
Yeah, it's this system the Treasury set up specifically so individual investors can get into the U.S. debt market directly, bypass the brokers, maybe save a bit on fees.
Exactly. And our source for this deep dive, it's not just some random analysis. It's actually from the US Treasury itself, a publication they put out called Investing Directly with the US Treasury.
Oh, nice. So we're getting the official word.
Straight from the horse's mouth, the rules, the how-tos, everything.
That's really valuable. No guessing games.
So our mission today is to really unpack this whole thing. We need to understand, first off, what are these marketable Treasury securities? And why does the government even sell them? What's this Uncle Sam's debt they mention? And crucially, how can you, as an individual investor, actually use Treasury Direct to buy them? We'll cover the nuts and bolts, managing the investments, even how the new system connects to the old legacy system they're phasing out.
Yeah, the goal is to really demystify it, give you a clear picture so you can figure out if this direct investment route is, something that makes sense for you.
Okay, let's jump right in then. First things first, terminology. The source keeps mentioning marketable Treasury securities. What does that actually mean? How is it different from, say, a savings bond?
Great place to start. So marketable securities. Basically, these are the ones you can buy and then potentially sell later on in what's called the secondary market.
Ah, okay. Like stocks or other bonds you might buy through a broker.
Exactly like that. You buy them, and maybe before they mature, you decide you want to sell them to another investor. That's possible. The main types we're talking about here are Treasury bills, notes, bonds, those floating rate notes, and TPS Treasury inflation-protected securities.
Got it. So they have that potential for liquidity later on. How does that contrast with like a regular U.S. savings bond, an EE or an I bond?
Right. Savings bonds are the opposite. They're considered non-marketable. Generally, you buy a savings bond from the government, and when you want your money, you cash it in, you redeem it back to the government.
You can't just sell it to your friend or on an exchange?
Nope. That marketability is the key difference. Now, Treasury Direct, the platform itself, it's mostly set up assuming you'll buy and hold these marketable securities until they mature. But because they are marketable, you do have the option to transfer them out to a broker if you need to sell early.
Okay. So marketable means they could be traded somewhere else, even if Treasury Direct isn't really built for active trading itself. More buy and hold.
That's it, yeah.
So bills, notes, bonds, FRNs, and TPS. These are the marketable ones we can get directly.
Precisely. And that leads to the bigger question. Why does the Treasury sell any of this stuff? You mentioned Uncle Sam's debt.
Yeah, the source uses that phrase. It sounds a bit casual, but it kind of gets right to the point, doesn't it?
It really does. Look, just like anyone else, you, me, a big company, the U.S. government needs money to run. They get a lot from taxes, obviously. But often, tax revenue isn't enough to cover everything they spend money on: defense, roads, social programs, paying government employees, you name it.
So when spending is more than income,
they run a deficit. And to cover that gap, plus pay back older debt that's coming due, the Treasury has to borrow money.
And selling these securities, bills, notes, bonds, that's how they borrow.
Exactly. They're essentially issuing IOUs. When you buy a Treasury security, you're lending money to the U.S. government for a set amount of time.
And in return?
In return, they promise to pay you back the original amount, the principal, on a specific date, the maturity date. And for most of these securities, they also promise to pay you interest along the way. It's how the government finances the public debt.
Wow. So you actually become a creditor to the United States.
In a small way, yeah. It's quite direct.
There's something kind of significant about that thought. And for making that loan, you get a return. Let's dig into the specific types available through Treasury Direct. We listed them, but how does the return actually work for each one? The source gives details, right?
It does. Let's start with the shortest ones. Treasury bills, or T-bills. These mature in a year or less. Through Treasury Direct, you can usually get them in terms like 4, 8, 13, 26, or 52 weeks.
Okay, and T-bills are a bit different in how you earn interest compared to, say, a note or a bond. You don't get those regular checks in the mail or direct deposits.
That's right, no regular coupon payments. T-bills work differently. They're sold at a discount from their par amount. The par amount is the face value, what you'll get back when it matures.
So you pay less than face value up front.
Exactly. Let's say you buy a T-bill with a $10,000 par value. You might pay, say, $9,800 for it. Then when it matures in, let's say, 26 weeks, you get the full $10,000 back.
So the $200 difference, that's your interest. Pay it all at once at the end.
Precisely. That's your return. Now, the source mentioned something about a discount rate versus an investment rate, which can be a bit confusing.
Yeah, what's that about? Which one matters to me as an investor?
Well, the discount rate is sort of an internal calculation the Treasury uses based on the par value and a 360-day year. Honestly, it's not very helpful for comparing yields with other things like a CD or a regular bond.
Okay, so ignore the discount rate mostly.
For comparison purposes, yes. The number you really want to focus on is the investment rate, sometimes called the bond equivalent yield. This rate is calculated based on the actual price you paid, the $9,800 in our example, and it uses a standard 365-day year, or 366 in a leap year.
So that's the rate I can compare apples to apples with the APY on a bank account or the coupon rate on a bond.
Exactly. The source specifically says the investment rate is the one for comparison. The actual interest, that difference between par and purchase price, you get that when the bill matures.
Got it. T-bills. Short-term discount purchase, focus on the investment rate for yield comparisons. What's next up in maturity?
Next are Treasury notes, or T-notes. These are medium term. Maturities range from 2 years all the way out to 10 years.
And how do they pay interest?
Unlike T-bills, notes pay a fixed rate of interest, often called the coupon rate, and they pay it every 6 months, semi-annually, until the note matures.
Okay, so with notes, you get regular income payments twice a year, and then you get your original investment, the principal, back at the very end, more like a traditional bond structure.
Exactly right. And then for the really long term, you have Treasury bonds.
D-bonds.
Yep. These mature in more than 10 years. Currently, the Treasury offers 20-year and 30-year bonds. Just like notes, these pay a fixed interest rate semi-annually until they mature.
So people looking for very long-term, steady income streams might go for these.
That's often the case, yeah. Think pension funds, insurance companies, or individuals planning for retirement far down the road.
Okay, so bills, discount short, notes, fixed coupon, medium, bonds, fixed coupon, long. Pretty clear distinctions. What about those other two? Floating rate notes, FRNs, they sound different.
They definitely are. Floating rate notes, FRNs. Right now, they come with a 2-year term. The key thing about them is that their interest rate isn't fixed for the whole 2 years. It actually adjusts every quarter.
Every 3 months. Wow. How do they decide the new rate?
It's linked to the discount rate on 13-week T-bills, specifically the rate set at the most recent T-bill auction before the FRN's rate reset date. So, as the source puts it, the interest payments you get from an FRN will rise and fall based on what's happening with those very short-term market rates.
So your income isn't fixed, it fluctuates.
Correct. Your semi-annual interest payment amount can change based on those quarterly adjustments tied to short-term rates.
That's interesting. I guess FRNs would appeal to someone who thinks short-term interest rates are going to go up and they want their investment income to potentially increase too instead of being locked into a fixed rate for 2 years.
Exactly. It gives you a different kind of exposure to interest rate movements compared to fixed rate notes and bonds. Okay, last one, and this one's pretty unique. Treasury inflation-protected securities. TIPI-FPS.
Yes. TIPS, the inflation fighters. Everyone talks about these when inflation spikes. How exactly do they work to protect you against rising prices?
This is where things get really interesting and, yeah, a bit more complex, but it's super important to understand their mechanism. It's quite clever. TIPS are issued in terms of 5, 10, or 30 years. The source explains their core feature. The principal value, the amount you initially invest, isn't fixed. It gets adjusted based on changes in the Consumer Price Index for all urban consumers, the CPIU. That's the main measure of inflation the government tracks.
Wait, so if inflation goes up, the actual amount of my investment, the principal, grows?
That's exactly right. The Treasury calculates an index ratio based on how the CPIU has changed since the TIPS was first issued. They apply this ratio to your original principal amount, or par value, to get the inflation-adjusted principal. Now, here's the really neat part. TIPS also pay interest semi-annually, like notes and bonds. But the interest rate itself is fixed. It's determined when the TIPS is auctioned. The trick is that fixed interest rate is applied to the inflation-adjusted principal.
Hold on. So the rate stays the same, but the amount it's calculated on changes with inflation.
Precisely. So if inflation happens, your principal value goes up. And since your fixed interest rate is now being applied to that larger principal amount, your actual dollar interest payment also goes up.
Wow. That is clever. It's like a double whammy against inflation. the principal is protected and the income stream tries to keep pace too.
Yeah, it's designed to maintain the real purchasing power of both your principal and your interest payments, at least relative to the CPIU.
What happens when the TPS matures? Do you get back the original amount or the adjusted amount?
At maturity, the source says you receive whichever is greater, the original par amount or the final inflation-adjusted principal. They call this a deflation floor.
A deflation floor, meaning?
Meaning, if there has been inflation over the life of the TPS and the principal value has grown, you get that higher adjusted amount back. But if somehow there was deflation during the term and the adjusted principal actually fell below your original investment amount, you're still guaranteed to get your original par value back. You can't lose principal due to deflation.
That's a really important guarantee. So downside protection on the principal against deflation, but upside potential if inflation increases it, plus potentially growing interest payments. That sounds like a pretty powerful tool for managing inflation risk.
It definitely is. Though, as we'll probably get into later when we talk taxes, that inflation adjustment, it does have some tax implications you need to be aware of.
Right. Always taxes. Something to flag for later. Okay, so that's our menu. Bills, notes, bonds, FRNs, and TPS. We know why the Treasury sells them. How do they actually get them out the door? It's not like walking into a Treasury store, is it?
No, definitely not. They're sold through regular auctions. Auctions are the main mechanism the Treasury uses to determine the price, and therefore the yield or rate for the securities they're issuing that week or month.
Auctions. Sounds maybe a bit complex or competitive, especially for just a regular individual investor. Is that how it works if I use Treasury Direct? Do I have to bid against big banks?
This is where Treasury Direct really simplifies things for individuals. While yes, big players like banks, brokers, and investment funds do participate through competitive bidding in these auctions, individual investors using Treasury Direct almost always use something called non-competitive bidding.
Non-competitive bidding. Okay, that sounds less stressful. What's the advantage? Why do it that way?
The huge advantage is simplicity and certainty about getting the amount you want. When you submit a non-competitive bid via Treasury Direct, you're basically saying, I agree to accept whatever yield or discount rate or discount margin the auction determines based on the competitive bids. You don't have to guess the market rate or worry about your bid being too low.
So I just say, look, I want $5,000 of this 5-year note, and I'm guaranteed to get it at the rate the auction sets.
Pretty much, yes. The key guarantee for non-competitive bidders is you'll receive the full par amount of the security you asked for, up to a pretty high limit, currently $10 million per option per person, which is way more than most individuals need. You won't get shut out because your bid wasn't high enough.
And I get the same rate as the big institutions.
Well, here's how it works. All successful bidders in that auction, competitive or non-competitive, end up buying the security at the same price. That price corresponds to the highest yield or rate or margin that was accepted among all the competitive bids that were needed to sell the total amount offered.
Okay, so the market sets the rate through the competitive bids, and I just agree to take that rate. That really does simplify things. I don't need to be a bond trading expert.
Exactly. You just need to decide which security you want, the type and term, and how many par value you want to buy. The auction takes care of the pricing based on overall market demand.
Where do I find out about these auctions? When they're happening? What's being offered?
The Treasury Direct website itself is the best source. They have calendars of upcoming auctions, details about the securities being offered, and also the results of past auctions so you can see recent rates. Financial news outlets usually cover this too. The source notes that the Treasury posts official announcements with all the final details closer to the actual auction date.
All right, so non-competitive bidding is the way to go for most individuals using the platform. How do I actually use the platform? How do I get set up and place that bid?
Okay, so that brings us squarely to TreasuryDirect.gov. This is the Treasury's official online system. It's available 24/7, and it's specifically designed for people like you and me to buy, reinvest, and manage Treasury securities directly.
This is the tool that lets you eliminate the middleman, like the source says.
That's a key selling point they highlight. The convenience of doing it all from home, the safety of dealing directly with the Treasury, and a big one they emphasize is the potential cost savings.
Cost savings how?
Because there's no purchase fee or commission when you buy securities directly through Treasury Direct.
Oh, wow. No fees at all. That's huge compared to using a broker, especially for smaller amounts. If you're buying, say, $2,000 or $5,000 worth, a broker's commission could really take a bite out of your return.
It absolutely could. Avoiding that fee makes direct investing potentially much more cost-effective, particularly for regular or smaller investments. So the first step is obviously getting an account set up.
Right. What do I need to open an individual account? Any special requirements?
According to the source, pretty straightforward for individuals. You need to be at least 18 years old, legally competent, have a valid taxpayer ID number, which for most folks is your Social Security number, and you need a U.S. address and a U.S. bank account linked for transactions. They also mention you can open entity accounts, like for trusts or businesses, but the rules are a bit different there. And how you can title the securities, like just in your name or jointly with someone or with the beneficiary, that depends on the account type too.
Okay, makes sense. So, account is open. Now I want to buy something. Where do I click?
Inside your account, you'll look for the Buy Direct function. That's the specific tool you use to submit those non-competitive bids for bills, notes, bonds, FRNs, or TPS. The source notes you submit one purchase request at a time using Buy Direct, but you can always go back and do another one right after.
Okay, Buy Direct. What info do I need to have ready when I go to make a purchase?
You'll need to specify several key things. The purchase date, this will link to a specific upcoming auction. The security type you want, obviously bill, note, bond, FRN, or PPS. The specific term, like 26-week bill, 10-year note, 30-year bond, and the par amount you want to buy.
Par amount, right. That's the face value I get back at maturity, assuming no deflation for TPS.
Correct. You also need to tell them how you want that specific security registered within your account. Maybe just John Doe or John Doe and Jane Doe with right of survivorship, or John Doe payable on death to Junior Doe.
Ah, okay. Title options.
Yep. Then the source of funds, how you're going to pay for it, and the destination for payments, where you want any interest payments, and the final principal redemption cent, usually your linked bank account. Oh, and right there when you buy, you usually have the option to schedule it for reinvestment automatically when it matures, if that's something you want to do and the security type allows it.
That seems pretty thorough. It covers all the bases. The source also had that funny little tip about actually using the website. Something about the browser buttons.
Oh, yeah. That's classic government website advice. They strongly warn you not to use your web browser's back, forward, or refresh buttons while you're logged into Treasury Direct.
Really? Why not?
Apparently, it can mess things up. You might get errors, or even that dreaded Treasury Direct not available message, which could force you to log out and start your transaction all over again.
Yikes.
So the advice is only use the navigation buttons and links provided on the Treasury Direct pages themselves. Don't touch the browser ones.
Okay, that's a golden tip right there. Stick to their buttons. Noted. So I've filled out Buy Direct, followed the button rules. How do I actually pay for the security?
Okay, funding. Two main ways. First, you can set up an ACH debit directly from a checking or savings account you've linked to your Treasury Direct account. It's like an electronic withdrawal they initiate.
Simple enough. Is there a limit on that? Like if I want to buy $10,000 worth?
Yes. This is a really important detail. If you're funding the purchase directly via ACH debit using that Buy Direct function, there's a $1,000 limit per transaction.
$1,000. That's quite low, so I can't just buy a $5,000 note in one go using that method.
Not directly through Buy Direct using ACH debit as the source of funds for the purchase itself, no.
Yeah.
That $1,000 limit applies per security purchase transaction funded that way.
Okay, that seems like a major hurdle for buying anything more than a small amount. What's the workaround then? How do people buy larger amounts?
The main way, and the method you'd probably use for anything over $1,000, involves using something called a 0% certificate of indebtedness, or C of I, within your Treasury Direct account.
C of I. 0%. Sounds like it doesn't earn any interest.
It doesn't. Think of the C of I as basically an internal holding tank, like a wallet, inside your Treasury Direct account. It's just a place to park cash temporarily before you invest it in an actual security or where proceeds can land.
Okay, a holding account. How do I get money into the C of I?
Now, this is where the flexibility comes in. Bypassing that $1,000 purchase limit, the source lists several ways to fund your C of I. You can set up ACH credits from your bank account to your C of I, basically pushing money in. And importantly, these transfers into the C of I initiated from your bank generally don't have that low $1,000 limit, though your bank might have its own limits.
Okay. So I push money from my bank into the C of I first.
Right. You can also sometimes direct deposits from your employer there, if they support it. You can direct your IRS tax refunds to your C of I. You can have matured principal or interest payments from other Treasury securities you already hold in Treasury Direct automatically deposited into the C of I. You can even deposit proceeds from redeeming savings bonds into it.
Wow, lots of ways to get money in there.
Yeah. And you can also initiate ACH debits from Treasury Direct to pull money into the C of I, but watch out that the $1,000 per transaction limit does still apply to debits into the C of I initiated that way. So pushing money from your bank is usually better for larger amounts.
Okay, so the strategy for buying, say, $10,000 worth of notes is, first, push $10,000 from my bank account into my Treasury Direct C of I. Then, when I use Buy Direct, I select the C of I as the source of funds for the purchase.
Exactly. You redeem the necessary amount from your C of I balance to cover the purchase. Since the funds are already inside Treasury Direct, that $1,000 direct debit purchase limit doesn't apply.
That makes much more sense. The C of I is the key for larger purchases.
It really is. Now, the source does note that when you place your bid, you don't know the exact final price until the auction results are out. But once your non-competitive bid is accepted, you're obligated to pay whatever that price is on the issue date. Sometimes the final cost might be slightly different from the par value, maybe involve paying a small premium, or something called accrued interest.
Accrued interest. What's that? Do I pay interest that built up before I even own the security?
Sort of, yeah. The source explains it. Accrued interest is the interest that has technically accumulated on the security from its official start date, called the dated date, up until the day it's actually issued to you and you pay for it, the issue date.
Why would those dates be different?
It often happens when the Treasury reopens an existing security, meaning they sell more of an identical bond or note that was first issued earlier. These new ones have the same original dated date. Since interest has been quietly ticking up since that earlier date, you, the new buyer, have to pay that bit of accrued interest to the Treasury up front.
Huh. Do I get it back?
Yes. You essentially get it back in your very first semi-annual interest payment, which will include the interest earned from the original dated date, covering the period both before and after you owned it. Just evens things out. TPS also almost always have different dated and issue dates, so paying accrued interest is pretty standard when buying TPS.
Okay, so it's not really an extra cost in the end, just kind of an accounting adjustment in that first interest payment. Good to know. All right, so I've got my account, I've funded it, maybe used the C of I, placed my bid via Buy Direct, the option happened, and boom, I own a Treasury security. Now what? How do I manage it?
This is where the online convenience of Treasury Direct really shines, like the source emphasizes. You can do a lot of your account management right there online, 24/7, using the Manage Direct section of the site.
Okay, Manage Direct. What kinds of things can I do easily online?
Quite a bit, actually. You can view your current holdings, see exactly what securities you own, their maturity dates, all that. You can check your transaction history. You can look at any pending purchases or reinvestments you have scheduled. And you can usually change or delete those pending items online, too. You can update your password and security questions. You can, of course, buy more securities using Buy Direct. You can update most of your contact information, although there are a couple of key exceptions we should talk about. You can also transfer securities between your own Treasury Direct accounts, as long as they share the same taxpayer ID number, like your Social Security number.
Oh, that internal transfer could be handy. Maybe if I have one account for short-term goals and another for long-term, but both are under my SSN.
Exactly.
Yeah.
You can also manage your reinvestment settings for existing securities. Maybe you didn't schedule reinvestment when you bought it, but now you want to. You can usually set that up online. And you can add or change the bank accounts linked for payments and funding.
Wow, that's a pretty comprehensive list. Sounds like most of the day-to-day stuff an investor would need to do is right there online. It seems to live up to that convenience promise.
For a lot of common tasks, yes, it absolutely does. However, and this is important, the source is also very clear that not everything can be done with just a click of a mouse. There are certain actions, maybe less frequent but still significant, that require you to go offline, fill out specific paper forms, or even make phone calls.
Okay, the catch. So it's not all seamless online convenience. What kinds of things require jumping through hoops?
Well, a big one is changing the name associated with the account holder. Like if you get married or divorced and legally change your name, that's not just an online profile update. It typically requires submitting a specific form called an Offline Transaction Request FS Form 5446, or maybe sending a secure message through the system, but you'll likely need to provide legal documents like a marriage certificate or a court order as proof.
Okay, name change needing extra proof makes sense. What else takes you offline? What about moving securities around?
Yes, transfers are another area. If you happen to still have securities in that older legacy Treasury Direct system and want to move them into the modern Treasury Direct system, that requires a paper form, the Security Transfer Request, FS Form 5179.
Okay.
And very importantly, if you want to transfer securities between Treasury Direct accounts that have different taxpayer ID numbers, say, moving bonds from your individual account to your kid's account, which has their SSN, or from your account to a trust's account, which has its own EIN, that requires a Certified Transfer Request Form, FS Form 5511.
Certified. What does that mean? Does that mean I have to go somewhere?
Bingo.
Yeah.
This is a key point of potential hassle, the source details. Signature certification means you can't just sign the form. Your signature has to be witnessed and guaranteed as genuine by an authorized official, usually at a bank or credit union. You typically have to physically go to the bank, show your ID, and sign the form in front of the official, who then stamps it with a special seal or guarantee stamp, like a medallion stamp if it's a broker doing it.
Wow. So to gift a bond to my child or move it into a trust, I have to print a form, go to my bank, get it stamped, and then mail it in. That feels quite a bit less convenient than 24/7 online access.
It definitely is. It adds steps, time, and potential inconvenience compared to purely electronic processes you might find elsewhere. It's a security measure, for sure, to prevent unauthorized transfers, but it's a definite point of friction where the direct system feels less modern. The source also implies some actions in the older legacy system, like address changes, might need a phone call or forms too, whereas some basic contact updates are online in the new Treasury Direct.
So the takeaway seems to be, for buying, holding, and basic management within your own accounts, Treasury Direct is smooth and online. But for life changes like names or transfers between different people or entities, or dealing with the old legacy system, be prepared for some paperwork and potentially a trip to the bank for that certification stamp.
That sums it up pretty well based on the source's description. It's a mix of modern online convenience and older, more manual processes for certain transactions.
Okay. Let's circle back quickly to reinvesting. You said you can set it up at purchase or later online.
Yep, the source highlights that flexibility. When you're using BuyDirect, if the security type is eligible for reinvestment, most are, except maybe some shorter bills or FRNs, you'll see an option to just check a box to automatically reinvest the principal into a new security of the same type and term when it matures.
And if I don't check the box then, or change my mind?
No problem. You can go into Manage Direct later, find that specific security in your holdings list, and if it's before the maturity date, there should be a link like Schedule Reinvestments or Edit Reinvestment. You can set it up, change it from reinvesting to not reinvesting, or vice versa, right there online.
Good flexibility. Okay, now, we established way back at the beginning that these are marketable securities, meaning they can be sold before maturity. Since Treasury Direct is mostly buy and hold, how does that work? If I do need my money early or want to sell a note I bought directly, how do I get it out of Treasury Direct and into, say, my brokerage account where I can sell it?
All right, good question. If you need that liquidity or want to actively trade it, you have to transfer the security out of the Treasury Direct system and into the commercial book entry system. That's the system brokers and banks use to hold and trade securities electronically.
And how do I initiate that transfer out? Is it online?
Unfortunately, no. Transferring out to a broker also requires that offline transfer request form, FS Form 5446. And just like transferring between accounts with different owners, this form needs to have your signature certified.
Ah, another trip to the bank. So selling early also requires a certified form.
It does. And on that form, you have to provide the specific electronic transfer instructions for the receiving broker or bank, usually their name, ABA routing number, and your account number at that institution, plus any special handling instructions they require. It's not just mailing a piece of paper. It kicks off an electronic transfer, but it starts with that certified paper form.
Okay. Are there rules about when I can transfer out? Can I buy a bond today and transfer it to my broker tomorrow?
No, there's a waiting period. The source states you cannot transfer a security out of Treasury Direct within the first 45 days after its original issue date.
45 days. Okay, prevents quick flipping.
Exactly. And there's another timing consideration to make sure the transfer goes smoothly and you don't, miss an interest payment. Because the security is in transit, they generally require the transfer request form to be received by Treasury Retail Security Services at least 10 business days before any scheduled interest or principal payment date. They say check for exceptions, but 10 business days is the guideline.
Okay, so transferring out to sell isn't instant. It takes planning, a certified form, you have to wait 45 days initially, and then time it around payment dates. Definitely different from clicking sell in a brokerage account.
Absolutely. It requires forethought. Now, what about the other way? Can I transfer securities I already own at a broker into my Treasury Direct account?
Interestingly, that process sounds much simpler according to the source. Transferring marketable securities in from a broker or bank that handles these kinds of transfers doesn't require you to fill out a form for Treasury Direct.
Oh, so how does it work?
Instead, you need to give specific instructions to your broker or bank, telling them where to send the security. You authorize them to push it into your Treasury Direct account.
What instructions do I give them?
The source provides the details. They need to know the receiving bank is Treasury Direct, all caps, one word. The ABA number is 051736158, and the account number is your specific 10-digit Treasury Direct account number, no dashes or spaces.
That's it. Just give my broker that info. Seems way easier than transferring out.
Yeah, seems much more straightforward on the Treasury Direct side. Your broker might have their own forms or procedures, of course. And, as we mentioned, moving securities from the old legacy Treasury Direct system into your new Treasury Direct account uses that FS Form 5179.
Right. Speaking of legacy Treasury Direct, the source talks about it quite a bit, clearly labeling it as the older system. What's its current status? Why is it still relevant?
It's relevant because, well, a lot of people presumably still hold securities there, but its status is very clear. It's being phased out. The source is explicit. You cannot open new accounts in legacy anymore, and you cannot buy or reinvest securities within an existing legacy account. All new purchases, all reinvestments have to happen through the modern TreasuryDirect.gov system.
Okay, so it's basically closed to new business. If someone does still have bonds sitting in a legacy account, what can they do? What are their choices? The source lays out three main options for those folks. One, they can just leave the securities there in the legacy account for now. They don't have to do anything immediately. The securities are still valid. They'll still mature and pay interest.
Okay, do nothing is an option.
Option two, they can transfer their securities into their Treasury Direct account. This moves them into the modern system for easier management, and that requires submitting FS Form 5179.
Right, the transfer form.
Option three, they can transfer their securities out of the legacy system altogether, sending them to their bank or brokerage account in the commercial book entry system. This also uses FS Form 5179, and transferring out of legacy like this also requires that signature certification.
Oh, okay. So moving out of legacy to a broker also needs the bank stamp. If someone chooses option one, just leaving things in legacy for now, how do they even manage that account since they can't buy or reinvest online?
Yeah, managing a legacy account is definitely more old school. It relies mostly on paper forms and phone calls to Treasury Retail Security Services. The source says you can still call them up to ask about your balance, request account statements, or get a duplicate 1099 INT tax form for the current year.
But not online.
Not really, no. For tax forms from prior years, you have to submit a written request. Changing things like your name on the account or adding or moving a co-owner requires submitting a certified transaction request form, FS Form 5178. Even just consolidating multiple legacy accounts that have the exact same registration requires that form. Changing your address or phone might be doable over the phone, but other updates need forms.
Wow, that really highlights the difference. Legacy sounds very paper-intensive, very manual compared to the online capabilities of Treasury Direct. It really underscores why moving assets over to the new system makes sense for easier management.
Absolutely. It's a night and day difference in convenience. The source does mention that payments from legacy accounts, interest and principal, are typically made via direct deposit, which is good. And they throw in a little historical tidbit about an old annual maintenance fee they used to charge on legacy accounts over $100,000 before 2014, saying it might have been tax deductible back then, but that fee's long gone.
Okay, good context on legacy. Let's move to that topic everyone loves, taxes. And keeping records. How does the Treasury report the income I earn from these securities to the IRS?
All right, taxes. The Treasury is required to report your interest income each year. For the regular interest payments on notes, bonds, FRNs, and also the semi-annual interest on TIPS, plus the interest earned on T-bills, which gets reported in the year the bill matures, they issue Form 1099 INT.
1099 INT, standard tax form for interest. Is there any difference in how I get that form depending on whether my bonds are in the old legacy system or the new Treasury Direct system?
Yes, and this is a super important distinction the source flags. It could easily trip people up. If your securities are held in a legacy Treasury Direct account, the Treasury will mail you a paper form 1099 INT in January.
Okay, snail mail.
But if your securities are held in the modern Treasury Direct account, your 1099 INT is made available only online. You have to log into your account, Go to the Manage Direct tab and find it under the Tax Documents section. They do not mail it to you. They do not email it to you.
Whoa, hold on. That's a huge difference. Online only for Treasury Direct 1099s. No paper copy unless I print it myself.
Correct. Online access only.
If you're used to getting tax forms in the mail, or if you transition from Legacy to Treasury Direct, you could totally miss that. You'd be waiting for a form that never arrives.
Exactly. You have to remember to proactively log in and download it yourself each tax season. Forgetting could mean delaying your tax filing or making errors. It also really emphasizes why keeping your contact info up to date is crucial, especially if you do still have a legacy account relying on mail. The source even advises legacy users who don't get a statement or 1099 to call and check their address.
Okay, critical difference noted. Legacy 1099s mailed, Treasury Direct 1099s online only. Now let's go back to TPS again. You hinted earlier that the inflation adjustment has tax implications. How does that get reported?
Right. TPS taxation is unique. This is another point the source spells out, and it often catches investors by surprise. Remember how the principal value of TPS adjusts for inflation?
Yeah, it goes up if there's inflation.
Well, that increase in the principal value, it's considered taxable income in the year the increase happens.
Wait, even though I don't actually get that extra principal money until the TPS matures maybe 10 or 30 years later?
That's correct. You owe tax on that phantom income in the year the inflation adjustment occurs.
So I could have a tax bill for money I haven't actually received in cash? That sounds difficult for cash flow planning.
It can be.
Yeah.
That's exactly how the IRS treats it. The Treasury reports this inflation adjustment amount to you and the IRS each year on a different form. Form 1099 OID. OID stands for Original Issue Discount.
Why OID?
Because the inflation adjustment effectively increases the amount you'll receive at maturity, similar to how a zero-coupon bond accrues value over time. This yearly accrual value due to inflation is treated as taxable income currently. The source is very direct. Increases in the principal value of your TIP is due to inflation are considered taxable income in the year in which they occur.
Wow. That is a really important thing to know. If you're holding TPS in a regular taxable brokerage account or Treasury Direct account, you need to be prepared to pay taxes each year on that inflation bump, even though the cash isn't in your hand. You'd need other funds to cover that tax.
Absolutely. It's a major reason why financial advisors often suggest holding TIPS in tax-advantaged retirement accounts, like an IRA or 401k. Inside those accounts, the annual OID income isn't taxed until you actually withdraw the money in retirement. Much more tax efficient.
Makes sense. What happens if there's deflation? The principal value could decrease, right? How is that handled tax-wise?
Good question. If deflation causes the adjusted principal value to decrease, this results in something called negative OID. The source says this decrease in principal value is reported only to you, the investor, not directly to the IRS on the 1099 OID form.
So I get the info, but the IRS doesn't automatically.
Right. Now, you might be able to use that negative OID amount to offset some of the interest income you received from the TPS that year, or potentially carry it forward or claim some kind of loss. But the rules get pretty complex. The source basically says, for handling negative OID, you really need to consult the official IRS instructions or talk to a tax professional.
Okay, so TPS tax reporting is definitely more involved than for regular bonds. You get a 1099 INT for the cash interest payments and a 1099 OID for the inflation adjustments, which are taxable income even if you haven't received the cash yet. And deflation creates negative OID, which needs careful handling.
It requires attention to detail, for sure, especially understanding that phantom income aspect of OID. And just to add one more potential wrinkle, the source reminds us that if you transferred a security during the year, say, from your broker into Treasury Direct or from Treasury Direct out to your broker, you might actually receive multiple 1099s for that same security in one tax year.
Oh, right. One from the Treasury for the time it was there and one from the broker for the time they held it?
Exactly. Both institutions are required to report the income that was earned while the security was under their roof, so to speak. So you'd need to make sure you gather both forms and account for all the income reported when you file your taxes.
That makes sense. Keep track of all the pieces.
Definitely. And the source wisely reiterates. For any specific tax questions or advice, Treasury Direct staff can't help you. You need to go to the IRS website, publications, or consult your own qualified tax advisor.
Sound advice. Okay, beyond the complexities of taxes, what about basic record keeping? Did the source offer any really crucial tips there? Maybe something easy to overlook?
Yes, they did offer one piece of advice that's incredibly practical and, honestly, vital. They strongly urge you to make sure someone else knows that you have a Treasury Direct account and knows how to find the necessary information about it.
Someone else. Like family or an attorney? Why is that so important?
It's crucial for estate planning. Think about it. If you pass away and nobody knows, you hold these Treasury securities directly, especially in an online-only system like Treasury Direct where there might not be regular paper statements coming. How would your heirs or the executor of your estate know these assets exist? They could easily be overlooked and never claimed. The money could end up lost to your family.
Wow, that's a sobering thought, especially with the online-only 1099s, too. It's not like they'll get a tax form in the mail reminding them.
Exactly. So the advice is simple but essential. Make a record of your Treasury Direct account number, maybe the types of securities you hold or how they're registered. Put this information with your important papers, maybe in your will or in a safe deposit box. And most importantly, make sure a trusted person, spouse, child, executor, attorney knows that this account exists and where to find that information.
That is incredibly practical advice. Not the glamorous part of investing, but absolutely essential for making sure your assets actually get passed on as intended. Don't let your direct investment become a lost treasure.
It's a simple step that can prevent a huge mess and potential loss later on. Really good advice.
Okay, wow. We have really taken a deep dive into the world of TreasuryDirect.gov today. We've unpacked what marketable securities are, the bills, notes, bonds, FRNs, and especially those unique to PS. We understand their features, how they pay returns.
And why the government sells them in the first place, basically, to borrow money and finance the public debt. We walk through the actual mechanics of buying them directly as an individual using Treasury Direct. Focused on that non-competitive bidding process.
Right, the simple way in.
Using the buy direct function and the different ways to pay, especially navigating that $1 K ACH limit by using the C of I holding account.
And we looked hard at managing the account. The upside is the 24/7 online convenience for a lot of common tasks through Managed Direct. But we also hit the friction points, the need for offline forms, getting that signature certification at a bank.
Yeah, the bank trip.
For things like name changes or transferring securities between different people or into trusts. Definitely not fully online for everything.
We also clarified the status of the old legacy system. It's fading out, no new activity there, and contrasted its paper and phone management with the modern online Treasury Direct system.
And finally, we dug into those crucial details on taxes and record keeping, how income gets reported on 1099 INT, the whole complexity around TIPSs, and that 1099 OID for inflation adjustments being taxable now.
That phantom income.
The potential for multiple 1099s if you transfer securities, and that absolutely vital tip about making sure someone else knows your account exists for estate purposes.
Yeah, we've definitely seen the benefits the Treasury highlights, cutting out the middleman, saving on fees, that direct government backing. Feels solid.
But we've also seen the nuances, right? The potential hurdles.
Yeah.
That $1,000 direct debit limit, needing certified forms for certain things, the unique tax situation with TPS, the fact that Treasury Direct 1099s are online only, the waiting periods and forms for transferring out.
It definitely makes you weigh the trade-offs. Is that direct connection and cost saving worth maybe a bit more legwork for certain transactions compared to the potentially smoother all-in-one-place experience of a brokerage?
So what does this all boil down to for you, the listener? Well, on one hand, investing directly with the US Treasury through Treasury Direct is a fundamental connection. You are literally lending money to finance the country's operations. It's not just about yield, it's participation.
Yeah, but on the other hand, given all these details, the ease of online buying versus the sometimes manual steps for transfers or estate issues, the fee savings versus maybe more complex tax tracking for something like TIPS want, it really pushes you to ask a personal question.
Which is?
Does this direct route, using Treasury Direct, genuinely simplify your financial life overall? Or does it introduce specific complexities like needing that bank certification or tracking OID income that might actually make using a full-service broker, even with potential fees, a better fit for your particular situation, your comfort level, and your goals?
That's the core question, isn't it? It forces you to weigh the tangible pros, like no commissions, against the potential cons, like procedural hurdles or tax headaches. When is cutting out that middleman truly the best path for you?
It's a really important consideration as you decide how and where to hold different parts of your investment portfolio.
Definitely something to think about. Well, this has been fascinating, really getting into the weeds of Treasury Direct. Thank you for joining us on this deep dive.
Always enjoy digging into these details. Thanks for having me.
We'll see you next time for another deep dive.